The following was recorded in front of a live studio audience at the Studio 21 Podcast Café. This is the United Podcast Network.
Welcome to the Stock Market Authority Podcast. I'm Bakes, Kevin Baker. I'm going to teach you how to make money in up and down markets. Very few podcasters or coaches cover this. I'll show you how to lock in profits and minimize losses to make you a better investor. So once a week, you're going to know what's going on in the world and the stock market. Welcome to the Stock Market Authority Podcast. Good morning. This is Bakes, Kevin Baker with Stock Market Authority. Welcome. Great to see you all and be in your earbuds as you're walking the dog or working out. What's in this for you? Sell stocks. I can't be more blunt than that. Sell stocks. If I had more exclamation points, I would. We closed below the 200-day moving average. I'm the only podcast out there that I found that talks about selling stocks as much as I do, and that's a big part of the equation. So we're going to talk about that. The mailbag, as it happens, brought in three of the Magnificent Seven: NVIDIA, Tesla, and Amazon. We're going to go through all of those, and then we're going to go through the Stock Market Authority portfolio, my search for the 10 best ETFs to make money this year, like we've done every year, including last year when everybody else was down, and we've made some changes there. But right now, today's top story. Paul Tudor Jones famously said, nothing good happens below the 200-day moving average. And this might get a little bit wonky, especially if you're just listening, but the bottom line is the 200-day moving average is the line under the chart that shows, it's a smoothing mechanism that shows the longer-term trend. And the S&P 500 this week just closed below the 200-day moving average. Not by a lot, but it did it 2 days in a row. It bounced feebly. It's down again today. And yes, there are some times when it tests it, breaks it by a little bit, and then reverses to the upside. But the fact that we talked last week about interest rates really breaking out decisively, and I showed you that, it's a trend after 40 years of interest rates going north. And we hit 10% on 5% on the 10-year this past week, and now almost like a domino, it's impacting the big stocks. We've seen a lot of deterioration in various groups, utilities and staples and what have you, and now it's coming after the generals, and we're going to go through that. What also struck me is volume. As you know, if you listen to this at all, I use volume as a tell, if you will, a confirmation or a refutation of what the price is doing. And I just think it's this simple. Yes, I know there's all computers and algorithms now, but it's still something is creating abnormal buying pressure or selling pressure. And so when I see this S&P 500 close below the 200-day moving average 2 days in a row on big volume, it suggests to me that there's a lot of systems out there and a lot of real live human beings saying, I've had enough. I can get 5% in risk-free treasury bonds and, frankly, treasury bills, the 1 year, and I don't need to take the risk of these sky-high valuations, bad news out of Gaza, bad news out of Ukraine, bad news out of Washington. You get the idea. And these things don't happen. They happen slowly and then all of a sudden. And now I think it's all of a sudden. This is also in juxtaposition to, there's a lot of people talking about seasonality. This is the good time of the market, okay? It's October 25th, and this is when you're supposed to be buying stocks for Santa Claus and everything else, the big rally that comes up at the end of the year. That's okay, but no one is telling the charts, and no one is telling the market participants that they should be going up. I'm watching as I walk in here. I've got it on my phone. Yeah, okay, Microsoft had a good report. It's up 4%. Google, they didn't like what they said about cloud. That's down 9%. So, you can do that math. These are starting to weigh. So if people were thinking that earnings were going to bail us out and give us solace and drive stocks higher, it simply isn't happening. And I like to invest in the market I have, not the one I hope for. And so, yes, if I saw the market come down, kiss this 200-day, and then reverse on big upside volume, different story. But that isn't what's happening, and we're running out of real estate here. So, I like to be settled as a 2x4, and I like to get you out of harm's way. And this isn't every stock that should be sold, because we still have 10 that we own that are working, but we had to close below the 200-day moving average in the S&P 500. The market, as far as I'm concerned, and most people are concerned. The fact that we talked about rates going up and now it's filtering its way into stocks makes sense to me. And it's also just being manifested in the chart. And we get, the Magnificent Seven that people talk about. We've got a bunch of those taking on water, and we'll talk about that later. So do me a favor, please. Go to my website, stockmarketauthority.com. Sign up for my free newsletter. You get my how to sell video, and I hope I'm impressing upon you that I know something about this. I've gone through, I can't tell you how many iterations of this that we know how to sell. I know how to sell, and I'll teach you. And so that's today's top story. Now it's time to check out the mailbag.
Incoming! There's a letter in your mailbox.
You got mail. Bill from Nashville came in. Bakes, why do so many people hate NVIDIA? And it's weird how the mailbag is full of the Magnificent Seven, but it makes sense because people are talking about, that's what's levitating the market, and there's all these termites in the foundation underneath that are taking it out. NVIDIA, first off, I'm going to follow my son Jack's advice. This is a hold. Okay, so it's going to be buy, sell, or hold. I'm going to be really specific. And the reason they hate it is they don't own it. And so they have to go, the pundits that are on CNBC and Bloomberg, if you have to go to your pension committee that you work for and you charge them 75 basis points, whatever the number is, and the S&P is beating them by 6 percentage points, and you don't own NVIDIA, you have to come up with smart-sounding reasons why it's not a suitable investment for them, even though it's number 6 in the index, whatever the hell the number is. And that's just the cold, hard realities of the business. And so, the valuation is extreme. AI is overhyped. There's double ordering in China, et cetera, et cetera, et cetera. And they missed it. The bottom line is, and a lot of people missed it. And so that's where NVIDIA is now. We had this big, spike above 300 on the first earnings report where they obliterated numbers. And here we are in this band between 400 and 500. And it's building a stair step. That's what it's doing. Now, having said that, this past week or so, we've seen the first signs of weakness. And again, I point you to this right arrow here I have on the bottom. The volume is picking up on the down days. So it suggests that people are becoming more anxious about the earnings report in 25 days, who the incremental buyer is. I don't know, but now it's starting to weaken. And as great as this company is and as big as the moat is, the valuation is not cheap. There's no question about it. It looks like it's 29 times on 2025. That sounds like it's a big number, and that's a long way away. They're growing far faster than that on the bottom line. I listen to the CEO every time he appears anywhere. He sounds 10 feet tall and bulletproof to me. The stock used to look 10 feet tall and bulletproof, and now it looks like it's 8 feet, and it might have been nicked by a bullet. I don't know. I'm mixing my metaphors here, but you get the idea. The volume's picking up. It's the first time. I used this before where I said this isn't Cisco in 2000 because people pull that out as well, saying, this is like the tech bubble of the late 2000s. No, it's not yet. And now, for the first time, I've been talking about this for months, and I'm glad you brought it up, Bill. There's some changes happening to the negative. Now, again, nothing definitive. And I think we're going to learn a lot on the earnings call on in 25 days, whenever the heck that is. And my concern is they have another blowout quarter, and the stock goes down. And that would suggest that no matter what the fundamentals are, you can't give people enough to fill this valuation. So the chart is always the umpire in this case, the arbiter. And right now, it's starting to show weakness for the first time. So it's a hold. Watch the 200-day moving average like a hawk, which is pretty far south from here. And stay tuned to here, and I'll let you know when something really happens meaningful with NVIDIA that we have to be more concerned about. So I hope you're picking up this change in tone that I have. It's very organic. It's simply from going through 3,000 plus charts and saying, okay, things are changing. Things are changing, and I don't want to. It's always, it takes 100 years to grow a forest, and it takes a drunk with a match to burn it down. The downside of when sales really start to happen, I think is going to be pretty severe. We're not there yet with NVIDIA, but I'm just watching out for it, so I hope I've been helpful. Sally from D.C., what do you think about Tesla's quarter in stock? And I know this sometimes becomes the Tesla show, but it's topical. It comes up all the time. It's widely owned. It's big in the S&P. It's part of the Magnificent Seven, if you will. This isn't magnificent anymore. This is a sell. And am I being vegan? Sell at least a third. They missed on the top line and the bottom line. So all these price cuts they've done on all these models aren't driving the demand that they wanted for. And it's impacting margins, top line, bottom line. And then the call, Elon became, an economist and said, I can't quote him, but, he was very downbeat on the economy. And it just, when interest rates go up, your car payment goes up, you can't afford as much car, and it impacts. It just has to. It just has to. Now that's coupled with technical damage. A close below the 200-day on big volume, and things are changing for the negative at Tesla. If you have a people, planet, profit bent, it's more environmentally sound and impactful to buy uranium for clean and sustainable nuclear energy than to own Tesla. And he's also alienating people with Twitter and leaning right and some of the things he says. So Tesla, to me, and I know this is a big share scoop stock as well, I would sell at least a third, and then stay tuned here to watch when the other two parts of the sell discipline kick in. I didn't pull my book out. It's in my bag over here. But I've studied this a lot, and I've gone through hundreds of examples of from the past, and this is how sales and sometimes short sales start to develop with action like this. So it's a sell, at least a third, and come back and ask me again, if you see things down the road that change. Joe from Austin, Texas, said, Bakes, Amazon, is it a buy, sell, or hold? It's a hold. I obviously, by my tone, you could tell I'm unenthusiastic. And oh, by the way, the Magnificent Seven, Tesla isn't magnificent anymore. And I don't think Google's magnificent anymore from the earnings report that they put up yesterday. And Amazon, they're going to report pretty soon. This is the subject of my how to sell video from my website, and it's still valid. Okay, but I put one arrow here to summarize the three parts of the sell discipline, but it basically got you out at 165. And the stock plummeted to 80-something, and now here we are, 128, 50% retracement, pretty kind of classic sort of stuff from the peak. So it looks like it's rolling over to me. The volume is not as extreme as the prior example that I just gave with Tesla. It's also, if Google's complaining about their cloud business, what's Amazon going to say about their AWS division which is a big part of the growth story. And I'm going to bring up another thing, and this is going to sound like heresy, but Peter Lynch was wrong. And that's tongue-in-cheek. I don't mean that. He's a brilliant investor, manager of Magellan, wrote a book called One Up on Wall Street. And the thought process was, if you're buying Nikes, you ought to own the stock. If you're drinking Starbucks, you ought to own the stock. Familiar kinds of companies. And when I look at student-managed investment portfolios, SMIFs, around the country, they kind of own the familiar names, the Lululemons and the Amazons and the Teslas, and I think there's some validity to that, but unless you're Homer Simpson, you're not working in a nuclear plant, and you don't have any firsthand relationship with uranium, but uranium is going to work over the next year or two, at least. So I love these great companies that grow to these behemoth sizes and these multi-trillion-dollar market caps. But there's so many things that do. You don't have to exclusively invest in those. And if you own an index fund, they're going to buy an S&P index fund. They're going to own them. You're going to own them automatically. So that's my thought process. I like owning the S&P, and then I like doing my stuff so we can make money every year and have a lot of fun with a lot of these quirky groups. So that's it for the mailbag this week. If you want to write into the show with any questions or comments, email me at bakes@stockmarketauthority.com. Even better, leave me a voice recording. Maybe my Australian friends will help me out with that, and we can play your question on the show. Let's take a break. When we come back, we'll take a look at the Stock Market Authority portfolio, and I'll give you this week's Bakes Takes. You're listening to Stock Market Authority. Hang in there. We'll be right back.
Do you want to become a better investor? Do you want to learn how to make money in both up and down markets? Then you need to go to stockmarketauthority.com and sign up for our free newsletter today. Stock Market Authority is run by award-winning investment manager Kevin Bakes Baker. His aim is to save you time while teaching you how to be a better investor. Bakes saves you time by diving into all the latest stock market news and information so that you don't have to. He reads all the latest articles, analyzes the charts, and listens to all the relevant podcasts. And then once a week, he gives you a breakdown of what's happening in the market. Stock Market Authority is constantly outperforming the S&P and the HFRX. Bakes is going to share with you his weekly stock observations. He'll give you concise insights and show you how to lock in profits and minimize losses. Stock Market Authority is making money in up and down markets. Wouldn't you like to do the same? So join now and let Bakes show you how. Head on over to stockmarketauthority.com and sign up for our free newsletter today. That's stockmarketauthority.com, making money in up and down markets.
We are back, and today we're talking about sell stocks. Nothing good happens below the 200-day moving average. It's like a nightclub at 2. So now it's time for the Stock Market Authority portfolio. And I must be nuts because I put this up here, but I like to keep my feet to the fire, and I'm trying to prove to you that I know what I'm talking about. And the first thing I want to mention is I have no big losses. And be honest with yourself. How many big losses do you have in your portfolio right now? And I just don't let it happen. And this happens over 25 plus years, starting with a crash of '87. I learned that if you cut losses and let your winners run, it's a lot more fun. And to spend 80% of your time on your 20% of losers is just lousy. So I've got 8 stocks in the green, ETFs in the green, and 2 very, very small losses, and nothing in double digits. So cutting losses really, really works. So enough of that diatribe. Our performance, we're up 2 times the hedge fund since we started. We get to go short, so I like to compare myself to the hedge funds. This year, we're down 12%. The market's up 10. We beat the market by 25, 26% last year. They're beating us this year. But, I'm throwing punches around and preaching from my chair, like Pete Townsend would say. We try to make money every year. I try to make money every year. It's me. And so far, so good. And I just, I listen to a lot of people, especially older folks, saying, I just got a settlement or an inheritance, and I want to invest it, but I don't want to lose money. Well, we're a partial solution to that, I think. And with the explosion of ETFs, there's 3,000 plus. When I go to my MarketSmith system, it takes me about a day. I go through 3,000 plus ETF charts and find all these crazy things that we can do that aren't your boilerplate buying Amazon and Tesla. And your money manager has a different goal. They get paid to beat an index, and so if the S&P's down 20 and they're down 15, they get high-fived and a bonus. And I think being up 6 or 7 like we were last year makes more sense. So enough of that self-aggrandizement. The end game, what am I doing this for? Eventually, I want to wrap all this into, one Bakes ETF and be your hedge fund that makes money every single year, all weather, simple, fun, less expensive. You get the idea. So stay tuned for that. Right now, we're 25% in uranium. Yes, this became the uranium channel about a month or so ago. I tried to, not beat that dead horse, but I wanted to impress that, that was the time to buy. And this is the time to hold. The uranium story is very much intact. We are, the spot price is at 73.74, so we've taken out those 2011 Fukushima highs, so that we've eaten through a lot of resistance, and it took obviously 12 years to do so, but it's game on, folks, and we need nuclear power. We need uranium to feed all these nuclear plants that are being extended and are being built, particularly in China, and we're right, and we're going to stay right for as long as we need to. We're 7% oil and gas services. I don't own any of the producers, and it's acted okay. We're 17% AI, robotics, technology. ETFs that have NVIDIA is their top 3 name, that kind of a thing, and that's working out all right. Bitcoin, we're 13% in Bitcoin through the Grayscale Bitcoin Trust, and that's worked out wonderfully. We're up 30% plus. The spot Bitcoin took out 31,000, so it's eaten through a lot of resistance. And I think the possibility of Bitcoin doubling is on the table. That's the prior high, and we've had the SEC not challenge a court case that they lost, which means the likelihood of spot ETFs being approved and incremental buying demand showing up, I think, is there. And that's also coupled with the fact that we've got a government that is dysfunctional and wasteful, and they're getting called on it. And so the dollar depreciation is certainly potentially there. We're 10% in Egypt. This is a new one. We're learning a lot more about this, but the chart is absolutely beautiful. We shorted real estate, 7% real estate through REK. Again, we talked about this last week. It's not the San Francisco apartment buildings and the Boston office buildings that I wish it was, but needless to say, rates going up, it's bad for real estate. And we're short the Russell 2000, the small caps. 4% of that. We're 1% in Pakistan. Oh, I know what you're thinking. Another podcast talking about the Pakistan stock market. I'm the only one, trust me. And we're 6% in cash. So that's a weird portfolio to buttress and balance against your S&P portfolio. And here we go. This next chart is the Grayscale Bitcoin Trust, and I hope I'm. Your eyes are becoming trained. I know if you're, walking the dog, you're not going to see this, but I want to see new highs, relative strength, and increase in volume on the up days. And this is just absolutely classic, where it simply suggests that from the time we bought this in June at $18, it's being confirmed by the price action and by the volume. And we're at 26 plus now. We're up 44%. Again, the Bitcoin spot price is above 31,000, and it's just one of the prettiest charts out there. And I'm no schoolboy, but I know what I like. And I like Bitcoin, and I like the Grayscale Bitcoin Trust. The next one is REK. We shorted the Russell 2000. You can see here the arrows that I've drawn, the new high, the big volume, and it just confirms that there's a negative change in the Russell 2000. This is an ETF that benefits when the Russell 2000 goes down, it goes up inversely. So it shorts, it goes the opposite way of the Russell 2000. This is the small caps. They have a big percentage of them are unprofitable, so higher interest rates are going to hurt them more, I believe, in terms of their valuations. There's a high percentage of regional banks in here, which act awful. And I can read a chart, and this is I think, a way to make money in a down market. That's our tagline: how to make money in up and down markets. And if this market really accelerates to the downside, I want to have some exposure just like this. We bought Egypt this past week, EGPT, the Van Eck Egypt fund. This is oil and banks heavy. Again, I'm learning a lot more about this. The chart is absolutely gorgeous, and I like going where other people aren't going to be until much, much later. So stay tuned. There'll be more on this, believe me, coming down the road. I'm going to go through recent improvements in my newsletter and social media posts. Please subscribe, follow, and share. That's how we're invested October 25th. Let's get into this week's Bakes Takes. And here are my takes. I'm reaching out to every student-managed investment fund in universities around the country that I can, and help me out with that, please. If you have a connection, I want to know about it. This is free, and what I find is that the traditional curriculum covers the buy side. It doesn't cover the sell side. So I hope I'm showing I know how to sell. I have a discipline that I think you should at least be aware of and adopt. I teach you how to read charts, which also is given short shrift in traditional academia. And I know how Wall Street really works. I've been 25 plus years in the business, 6 different firms. I kind of know where the bodies are buried. And I'll tell you, how this really works outside of the textbooks. And I hope that's valuable. I think it is. That's my feedback that I'm getting from you, so forth. I included here, and I encourage you to listen, click on the link and listen to the Lots More podcast. This is from Bloomberg. Tracy Alloway and Joe Weisenthal interviewed Gregory Brew, who is an analyst at Eurasia Group. And he has studied Iran and oil and geopolitics more than I certainly have, very knowledgeable. But I listened to this and I just said, rising oil prices seems inevitable between the conflict that's there now, the neighboring countries, talk of embargoes already starting to happen, the potential for supply disruptions. It just seems almost inevitable to me, and that's what I walked away from. And then I went back to my SPR chart, Strategic Petroleum Reserve, and my politics are pretty obvious. But Biden tried to shave. He shaved 20 cents off of gas prices at the last election. He depleted the Strategic Petroleum Reserve. It's down to all-time lows, 19 days, just in time for Hamas and Israel to really flare up. And so, again, there's no bailouts coming from the SPR this time, and the supply disruption risk, I think, is substantial, and I think demand's okay. And so, again, there's 2 different aspects that I think are pushing energy prices higher. I couple that with trying to weave all this together a little bit. Last week I showed the interest payments of the federal government, and now I'm showing the federal debt. And the debt is now $25 trillion plus and growing. And the interest rate on that is growing as well. And so no one cares about debt and deficits until they do, and the bond market tells them to. And with the 10-year hitting 5% this past week, the market is starting to say, we demand more interest for the risk you're putting on us by lending you money for the next 10 years. And this makes it, to me, I don't see how that's going to change anytime soon. Then I couple that with the regional bank chart. And this is the KRE. This is the S&P Regional Banks ETF. And what sunk the Silicon Valley banks of the world back in March was they invested money in bonds at 1% and 2%. Now those rates are 5%, and the value of the bonds are down, and it whacks the capital base of the bank. And now you layer on top of that the fact that you've got a credit cycle, you've got commercial real estate starting to weaken, and it's showing up in the chart here. This bank index, the regional banks, less so the JP Morgans and what have you. This is rolling over and breaking down, and the volume is confirming it. So it feeds into my Russell 2000 small cap short. Regional banks, I think it's a lousy business and it's getting worse, and that isn't a fun place to be, in my opinion. So do me a favor, go to my website, sign up for my free newsletter. Those are my baked takes for this week. As we close out this show, I always like to end with some much-needed levity. And this is Brian Regan, Mom and Dad, this is clean. It's about 6 minutes. Some very funny bits in this, and I recommend it highly as the antidote for my sell stocks theme for this for the past half hour. Thanks for being with me. I appreciate your attention. I know you have a choice of a lot of podcasts. Thank you for flying with bakes. And I will, I don't know what the hell I'm talking about next week. You tell me what you want me to talk about, and I will see you soon. All right? Keep smiling. Bye now.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Café, the United Podcast Network, its partners, or affiliates.